Hey, howdy, it is Ashley and Bill for another mortgage moment. I'm Ashley Tellis, a real estate expert in the Dripping Springs, Texas area. And this is my cohort in money, Bill ROEGELEIN, doing loans all over Texas and several other states. So we like to bring just some tips and tricks and hints and clarity around money and mortgages and interest rates and all things tied to financing homes. So Bill, thank you for joining me as always. And I think today we're going to talk a little bit about refinancing. And so first I'm thinking, well, why would anybody give up their low interest rate and do a refinance? Why would anybody want to refinance today?
Yes, great question. And welcome back. Hope you had a great birthday.
I did. Thank you very much.
Good. So yes, refinance is a big question. We're all aware 2023 was a hectic year. Rates were at their highest they've been in a long, long time. So refinance is the word that's been told probably to anyone buying a house this past year is don't worry, you can refinance or date the rate, marry the home because you're able to get a cheaper rate or lower rate down the road. So refinance and why and what makes sense. So I think there's three big opportunities for a refinance. We'll talk about rate first because that's just the biggest kind of elephant in the room is my interest rate so high. So to really make sense, at least from my standpoint and most lenders out there, almost all lenders, I hope, is the benefit it's going to make the borrower for saving money. So if your interest rate 7% and you say, okay, listen, let's refinance you can get you down to 6.75. Yes, there's a little bit of money savings there, but it just doesn't make sense for a benefit for the borrower. What we're looking at, depending on the situation, is a good point. If it's 6% available and they're ready to refinance, that's what saves them $100, $200 potentially on their mortgage payment. So we're looking for a big rate benefit, okay, and change on there. So that is the big thing from a rate standpoint. The second I would say is, hey, you have enough equity in the house and you've been paying mortgage insurance for God knows how long. The way to get out of mortgage insurance, depending on what kind of loan you have, FHA or conventional mostly, is you've got to have at least 20% equity in the house to remove mortgage insurance. So, hey, maybe the rate isn't a full point better, but it's a little bit better, and you've put some money towards the house and you can get rid of that mortgage insurance. Whatever that is, it could save you another $50, $100 or so. Appraisal comes in, it gives you the value of the house. Depending on how much you still owe on it, that would tell us how much equity is in it. So a good number two, removing mortgage insurance. No one likes that. Number three, I would think, and just depending on the scenario or the borrower, is debt's become a big word this past year. Racking up credit cards, paying a lot. And so a lot of people are kind of just bogged down with debt. And, a good opportunity for an individual is doing a cash out refinance, consolidating your debt, like we'd say. Yes, you might have a 3% interest rate from the COVID times and it feels so good, but with times and how they're happening, you've got all this debt now. You've got all these credit card payments. They could be $500, $600, $700, $800 a month that you're paying on car payments, or maybe it's credit card payments or a car payment. There's ways to cap into your equity for your house to pay those debts off. So yes, your mortgage payment might go up $500, maybe $1,000 potentially, but if you add up all the monthly payments that you're paying off, for instance, I just did one and saved an individual almost $1,800 a month in credit card debts and some car loans that they paid off by tapping into their house. So cash out refinances are good. Yes, your interest rate could go up depending on what you're sitting at, but at the end of the day is money in your pocket where, listen, you can always put an extra payment into your house to get that, to get those principles down lower. So back to review is obviously rate decrease. You got to have a good rate improvement. That's a big obvious opportunity here with these past rates this past year. Two is maybe mortgage insurance. Is time to take a look at your equity and get rid of that. And then three is debt consolidation. You'll see that word a lot, debt consolidation. Let's look at your house, your equity, and see if it's something you can tap into.
And if people have more questions about their scenario specifically, would you take their call or email?
Oh, 100%. And we've got fancy calculators that can break it down to the dollar interest saved. Listen, let's look at all your debts you have. You're looking at a cash out, and then compare it to what your payment might change to see the real tangible benefit for that individual. So absolutely.
Awesome. Awesome. Well, Bill, thanks as always for joining me and getting all the info out to folks. Again, if you have more questions about your personal scenario, reach out to Bill, or you can reach out to myself and I'll put you in contact with Bill. And that has been another mortgage moment. All the rest of our videos are here on YouTube if you want to pop around and check out the different topics. And we'll see you next time.
Have a good one.